All right, let's get right into it. Today, we're staging a showdown between two absolute titans of the growth ETF world, Schwab's SCG and Vanguard's VUG. Now, if you just glance at them, you might think they're pretty much the same thing. But trust me, underneath the hood, they are running on completely different engines. Let's figure out which one is the right fit for your portfolio. This whole debate really boils down to one simple but kind of tough question every investor has to ask themselves. Are you here to play the long game, patiently letting your wealth compound year after year? Or are you trying to catch lightning in a bottle to really juice your returns when the market is hot? Your answer to that question, well, it's going to point you straight to one of these ETFs. And this slide, it lays out the two game plans perfectly. You've got SCHG on one side, that's your steady compounder, the one built for a marathon. And on the other side, you've got VUG, the cyclical engine that's tuned for a flat-out sprint. One is all about endurance, the other is all about that explosive off-the-line power. So here's how we're going to break it all down. First, we'll tackle that core dilemma for growth investors. Then we'll put SCG and VUG under the microscope, one by one. After that, we'll see how they actually perform head-to-head, and we'll wrap up with how you can actually build a strategy using this info. Okay, let's start with the big picture here, the investor's growth dilemma. And this isn't just about picking a ticker symbol, It's about picking a philosophy. Are you the kind of person who wants to back high-quality companies that are already profitable? Or are you trying to ride the hot hand, chasing the momentum in the market? So how can two ETFs that look so similar be so different? Well, it all comes down to the rule book they follow, what we call their index methodology. As you can see, SCG's rulebook is all about quality and profitability. VUG's, on the other hand, is built to chase momentum and the latest growth trends. Honestly, this one little difference, it explains everything that follows. All right, let's meet our first contender, SCHG, the steady compounder. The best way to think about this one is as the Warren Buffett approach to growth investing. It's all about finding durable, disciplined companies that are built to last. This quote just nails the entire SCHG philosophy. It's not enough to find a company that's growing fast. The real question is that fast-growing company actually profitable? Does it have a solid balance sheet? For SCHG, quality always comes first. If you need an analogy, think of SCHG as an electric hybrid car. It's super efficient, gives you a smooth, steady ride, and it's built for incredible range. It might not be the fastest off the line at a stoplight, but it's going to get you to your destination reliably with a lot fewer bumps along the way. Now, the numbers on this slide, they really tell the story. First off, that expense ratio is practically free at 0.04%. It holds around 250 stocks, so it's a little more spread out. But look at that turnover rate, super low. This fund isn't chasing trends, it's buying and holding. And that slightly higher dividend, that's the classic sign of mature, profitable companies sharing the wealth. And when you look at its top holdings, you see the names you'd expect: Microsoft, Apple, NVIDIA. But here's the key. Together, they make up about a third of the fund. So yeah, it's concentrated at the top, but there's still a full 2/3 of the portfolio spread out across a bunch of other quality growth companies. And now for our second contender, VUG, the cyclical player. So if SCHG is like Warren Buffett, VUG is, well, it's a bit more in the spirit of someone like Cathie Wood. Now, it's not nearly as extreme, of course, but the focus is the same, capturing that explosive, high-octane growth, especially when the market is at a turning point. This phrase right here is VUG's entire mission statement. This ETF is designed to absolutely crush it when the economy starts to rebound, when interest rates are expected to fall, and when investors are feeling optimistic again. It's all about catching that big recovery wave. So if SHGG is the efficient hybrid, VUG is the pure, raw, turbocharged engine. It's built for one thing: power and acceleration. Sure, it might be a little louder, and it might burn through fuel a bit faster, but when the road ahead is clear, this thing is built to fly. And the stats here paint a totally different picture. Same super low expense ratio, but look closer. It holds fewer stocks, which means it's more concentrated. The beta is higher at 1.1, meaning you should expect more volatility. And that turnover rate, it's nearly double SCHG's. That's the clearest sign that this fund is constantly rebalancing to chase what's hot right now. And you can really see that concentration right here.
Those same three tech giants, Microsoft, Apple, and NVIDIA, they often make up a whopping 35 to 40% of the entire fund. Now, that's a double-edged sword. It absolutely amplifies your potential reward, but it also amplifies the risk. When big tech is soaring, VUG is going to soar even higher.
All right, we've met the fighters, we know their styles. Now it's time for the main event, the head-to-head performance. This is where we see how these different strategies actually cash out in the real world. Let's look at the tail of the tape. So if you look at the last decade, you know what? It's pretty much a photo finish. VUG is just a hair ahead, but the difference is so tiny, it's basically a statistical tie. What this tells us is that over a long, full market cycle, both of these approaches can deliver absolutely fantastic returns. But here's where it gets interesting. Let's zoom in on the massive bull run we saw in 2020 and 2021. This is where you see VUG's turbocharged engine really kick into high gear. Its focus on momentum helped it surge almost 70%, leaving SCHG behind. This is VUG in its natural habitat. And then, the music stopped. During the big correction in 2022, the script completely flipped. This is where SCHG's focus on quality provided a safety cushion. Now, it still went down, let's be clear, but it lost less than VUG. That defensive strength is the hallmark of that steady compounder personality. This table really just sums it all up, doesn't it? SCHG gives you quality growth, lower volatility, and better defense in a downturn. VUG is all about momentum, higher volatility, and it shines when the economy is rebounding. The pattern is crystal clear. VUG wins the sprints, but SCHG holds up better and helps you endure the marathon. So what on earth do you do with all this information? Well, let's stop thinking about this as a duel and start seeing it as a potential duet. It's not always about picking just one. It's about understanding how these two can work together in your portfolio. Instead of going all in on one, you can actually blend them. A 70-30 split, with most of it in SCHG, gives you a really solid quality core with just a little bit of a kick. A 50-50 split? That's a balanced barbell approach to growth. And if you're a more aggressive investor, you could flip it to 30-70 to really lean into capturing those market cycles. It's all about balancing quality and momentum. At the end of the day, the right choice for you really comes down to your own psychology as an investor. Are you the patient builder? Do you believe in the power of compounding and just want to sleep well at night during a recession? That's SCHG. Or are you the opportunist? Do you thrive on change and live for those big, game-changing moments in the market? That's VUG. Knowing yourself is half the battle. And you know, that really brings us to the final big idea. Maybe we've been asking the wrong question this whole time. Maybe it's not about SCHG or VUG. The real strategic question is, when do you let each of these powerful tools take the stage in your portfolio? Think of it like conducting an orchestra. One provides the steady, beautiful rhythm, and the other hits those powerful, soaring crescendos. The best investors know how to use both.